You're already seeing mini lockdowns all throughout the country, margin and the pricing outlook, the market share gains from the unorganized sector, and of course the banking sector's credit cost guidance as well. Lots to chat about and lots to ponder in on as we step into this earnings. I have with me Venugopal Garre, the MD at Bernstein, joining in all the way from Singapore. And we have with us Nishal Maheshwari, CEO, Institutional Equities and Advisory at Centrum Broking, as also Rusmik Oza, Executive Vice President and Head of Fundamental Research at Kotak Securities. Gentlemen, good evening. Good to have you all on the show. Venugopal, if I could start the discussion with you, help me understand what is your own outlook of earnings and how they're likely to shape up for fourth quarter, for the full year, the next year. What is the kind of commentary that you're going to be looking out for from India Inc.?
This is the toughest question, given that looking at what is happening around the economy, especially COVID. I wonder if a lot of corporates actually sort of incorporate what could be the potential risks they could bring, in terms of their own business models, especially those which are more economy-facing day-to-day activity, which they have to do on the ground, whether they're going to incorporate this or not. And number two is also remember that the other interesting part is we are moving into a phase of a couple of months where the base is extremely supportive. But I think both from a corporate and a street perspective, there will be much more focus on sequential this time around rather than a YOY growth. So that needs to be put into context. At this juncture, I would probably say that looking at how macro has shaped up over the last 12 months, we are basically seeing the economy hold up at a certain level. So which means things are okay at this juncture as far as the overall activity levels from a revenue front are concerned, with certain areas seeing, of course, fair degree of strength. It could be perhaps, an IT or, some small value consumer discretionary and things like that. But the risk, of course, is in the commodity front and how it would probably play into margins for certain end markets in certain industries, which is what I think is going to be a challenge when companies sort of give their guidances. All in, I would probably say that what is there largely embedded in terms of Nifty estimates, which is looking at probably about 16-17% of top line growth and 30% of EPS growth. To a large extent, I think this is where most of them would initially give when it comes down to probably a bottom up sort of a guidance. Then we need to see how it eventually shapes up.
Right. So the point that you're making right now, Venugopal, the fact that there is a resurgence in COVID cases, will it have an impact on numbers, or would you say it's too soon to really assess that? And what will happen on that front, really?
I think it's very, very clear. It is not baked into numbers at all at this juncture. Because if you look at how these numbers are constructed by the street, including us, is that we have primarily assumed normalization of the economy next year. So what it primarily means is if you look at a GDP forecast, it's as well, we're looking at about 25% to 27% GDP growth rate in 1Q, moving to some 8% plus in 2Q, and then 4.5-5% in second half. I think probably RBI is similar to what we are in terms of the GDP quarterly forecast. But what does it mean? When I built these forecasts, I had assumed a lot of these end markets, which are usually very heavily COVID dependent, seeing things coming back to normal, right? So I think there would be a risk if COVID actually leads to activity levels reduce. Now, second thing is that, however, the broader opinion from me at this juncture, even when I comment on the markets and what one should do, is that this time around when we are seeing COVID, of course, death rates also picking up, but that level of stress we see in the system now versus what was a year back seems to be lower. So which means to a large extent, activity levels are still going on without any major shutdowns happening. So for now, it seems that probably we might just scrape through in terms of numbers. But yes, I don't disagree with you. It's an area of monitorable for us as well.
All right, let's focus in then on IT, because as always, it'll be kickstarting the earnings season. We've got TCS, Infosys that will be leading the way. So let's find out what the expectations are in terms of the kind of growth, guidance, commentary, deal wins, etc. And what is it that the street is penciling in. Sunita Nagpal joins in to give us a flavor of just that. Sunita?
Q4 is usually a weak quarter for IT companies, but it will be different this time. We are expecting strongest Q4 in last 5 years. That's the kind of expectations we are going in the earnings season for IT companies. As far as tier 1 companies are concerned, we are expecting them to post revenue growth of 2.5% to 4% quarter on quarter in CC terms. TCS is likely to lead the pack with 5% growth in dollar terms, and the growth largely will come from the strong deal wins they've been having for last few quarters, and the ramp-ups have started, and that's what will be reflected in the top-line growth for tier 1 IT companies. As far as margins are concerned, we are expecting TCS margins to remain stable, while in case of Infosys, ISL Tech and Wipro, there will be margin contraction because of the wage hikes they've undertaken. As far as tier 2 companies are concerned, we are expecting stronger growth coming from them. We are expecting their revenue growth to be anywhere between 3.5% to 5.5% growth. We are expecting Coforge to post very strong numbers, while Emphasis numbers might be slightly sluggish this time. It is all about the guidance for next fiscal year, and we are expecting all companies, whether it's top-line companies or the mid-cap companies, to say that they will be having double-digit growth. It might vary from early teens or mid-teens. That can be the only difference, but we are expecting a very, very strong guidance coming from all IT companies.
Rasmik, let's get in your take, and let's talk in particular about the IT sector as a whole. We have seen those deal ramp-ups kick in, and a lot of these companies as well are likely to see fairly decent cross-currency revenue growth. What's the expectation, and would there be a clear bifurcation from the large caps vis-a-vis what the mid caps could potentially deliver in this quarter?
Yeah, thanks. I think IT company numbers are going to be quite decent enough. Among the larger peers, the top 5 names, we're expecting anywhere between 15 to 22% kind of earnings growth in Q4. As I mentioned, the last 1 or 2 quarters have seen a lot of large ticket deal wins, which are more structural in nature. And these are transformation deals, trying to move entire lock, stock and barrel with employees taking over the entire projects, the teams, and then driving business for the next couple of years. Plus cloud transformation, entire backbone digitalization. So a lot of activity happening in the IT space. We are quite optimistic about the future outlook also. The only caveat in case of IT companies is that valuations have stressed a lot. So I'm not very sure how much more re-rating we can see in most of the companies. But nonetheless, we don't expect any major disappointment on earnings from most of the IT companies. So that's one. Among the mid and the large cap, we still prefer the larger names because in the last couple of months and in last 2 quarters, whatever big large deals, transformation deals which have come into the lot of the bigger players only. So the smaller players may not be able to capitalize on these kind of large ticket size deals. So valuations also, mid caps are almost at par with the large deals. So we prefer the larger companies. Our topic is Infosys in this pack, followed by HCL Tech and Tech Mahindra.
Okay. Metals, that's been the shining pocket year to date, and what a phenomenal rally they have had. Nishal, hi evening. Want to discuss what you're expecting from metals this time around. Higher LME prices, you've got the 13th consecutive HRC price hike coming in domestically. You've got that big infrastructure, $2.3 trillion, infrastructure stimulus as well, or package as well, announced by Joe Biden.
Evening, I think steel is in an extended bull run, actually. I think the rally has been pretty strong and we continue to believe that there is more to go. And if I look at it, any of the fundamentals as far as steel is concerned, whether it's in terms of the landed prices, whether it is terms of the export prices or international prices, I think Indian prices are, there is a fairly large gap. And on top of it, basically, they have been able to pass on the cost increases because there has been a fairly good demand as far as the consumption is concerned. So in our estimates, basically, even if we have taken almost around 8,000 to 9,000 rupees per ton on the HR, lower in the next year, still we are saying that there is going to be a very, very strong growth, almost 25-30% kind of across the numbers basically next year. And this quarter obviously is going to be an outstanding. Now, if you look at it, all these steel prices, all these steel companies, there are 2 or 3 things which are common. One is their balance sheets are becoming very, very light. Most of them have been able to repay the debt. Valuation-wise, basically, they are still lower than their 5-year peaks. Most of them are still available between 4.5 to 5 times EV to EBITDA, and peaks have been at around 7, 6, 7 for various companies. So I think there is a good way to go ahead. We at least believe another 15 to 20% run up for steel, most steel companies from here.
What happens to autos? Are they headed in for a bumpy road ahead? Because we've seen this sharp spike. We were just talking about metals. Input costs, of course, have gone higher for most auto majors. That pent-up demand has now, given up. And more importantly, affordability. Most of the auto majors have actually undertaken a price hike. So what happens at a time like this? Are autos now headed in for some sort of margin compression going forward?
Aisha, is this for me?
Rusmik, it's for you.
Yeah. So in case of automobiles, I think the second wave has again provided some fresh impetus in terms of volume growth, as we can see in the March numbers. And the delta of higher volumes is going to offset the input cost pressure for most of the companies. We're expecting anywhere between 35 to almost 100% growth in various companies across the board. In two-wheelers also, names like Hero MotoCorp will also report a very good set of numbers, including TVS. The only catch area probably could be Bajaj Auto, could be one company where we're expecting some kind of weak numbers in terms of earnings. Otherwise, Maruti, Ashok Leyland, Tata Motors, all the companies are going to report fabulous numbers for March quarter. And going forward also, maybe at least for next 2 quarters, in spite of the raw material cost pressure, the numbers could be good because of the low base. You had a complete, June quarter was a lockdown washout quarter, and then September was the recovery phase. So you still have a very low base for the next 2 quarters only. But in case of automobiles, our views are very divergent in many of the companies. We are less optimistic on the Maruti and other names. We are more bullish on some of the tractor PV players like M&M, Escorts, and Tata Motors could also be a good turnaround story. So net numbers are going to be very good in case of automobiles, in spite of the cost pressure in terms of metals going up for most of the companies.
Nishal, wanted to get in your take on the capital goods sector, because while it has been rough ride so far, the corporates that we've been interacting with seem to indicate that now capacities are continuing to operate at those normal levels. Execution is picking up. There has also been a lot of focus from the government on the PLI scheme, the infrastructure focus, etc. And then, of course, you've got the low base that will be supported by. So do you think that we can pencil in pretty steady revenue growth this time around? And despite the commodity price rise, that margins will continue to improve largely on the back of under recovery of costs on a yearly basis at least?
So I would divide the capital goods into 2 parts. One is power and X of power, basically. So largely industrial. I do not see much growth as far as power is concerned. I don't see large power projects being announced. Whatever is being done basically is largely replacement. And those capacities, I think there is a huge overcapacity in the turbine area, so I don't see any improvement out there. Yes, on the industrial front, our interaction with most of the corporates is showing basically there is a good demand, but not as yet. Basically, the PLI schemes which the government has announced, basically still, I think the implementation is going to take a bit of time. But having said that, I think most of the people have a good order book, and largely from food processing, sugar. These are some of these sectors basically which are giving them good orders basically at the moment. Cement is also contributing there. But the larger PLIs which we have seen, especially on the consumer goods, pharma and all that, has yet to show up in their order books. Chemicals is definitely showing up, but that is been there for some time now. On the margin front, I think mostly their contracts are passed through. So I don't see that there is going to be any issue about the margins. What we see is improvement on the working capital side for most of the consumer capital good companies. Given that the order books are good, they are able to negotiate a better terms with the buyers. So I overall see basically there is going to be improvement as far as balance sheets, profitability, and the like. I think all round improvement in capital good companies.
Venugopal, wanted to get in your view as to which sector you believe could do well, where you could see the base effect kick in when it comes to earnings.
Yeah, so I mean, it is the economy-facing sectors which are supposed to be the bigger driver for growth. So it would probably be financials, industrials, right? These are probably the two things. The third area where you should have seen is, things like airlines and, multiplexes and things. But of course, there seems to be some challenges out there. But the pure economy facing, deeply impacted by COVID, which we have just started seeing a recovery in those end markets, are the ones should have basically been driving, a fairly decent growth next year. But just to highlight that contextually, when we do a bottom-up sector-to-sector growth rate, in general, base has been supportive for quite a few of these end markets, except maybe consumer staples in IT. So you tend to see a general broad-based sort of earnings growth as well. So, so despite the peculiarity of some sectors being slightly higher.
Okay. Rismik, Nishchal, Venugopal, thank all three of you for taking the time out and very broadly analyzing what to expect from this earnings season. We're going to be kickstarting it next week itself, come Monday, and it's broadly expected to be a strong performance by most sectors with a preference towards cyclicals.